It's a real privilege to introduce Malcolm Harris to the club. Let's give him a warm Pachyderm Club welcome.
I tend to look at the data first, and then I go through and try to figure out what the warts of the data are. And that could be dangerous. You know, how many people really want to know how their car is working? And I'll tell you why. I'm that sort of person. I like numbers. B, when I did have to forecast $70 billion worth of revenues and volumes, the inputs into our models, which were actually quite sophisticated, I know it's a surprise, the inputs to our models were economic data. If the data is wrong, the model's wrong. At a previous occasion here, I gave a good example of that in 2001. But I'm not going back to that because right now we're trying to figure out what's going on. Are we in a recession? Are we going into recession? Have we missed the recession? If you read the financial press, if you read the regular press, you're probably baffled. And actually, if you look at the data, you're probably baffled too. And that's what I actually enjoy doing, believe it or not. I know, a bit weird. Sorry. If you saw my paper version of this, you probably couldn't read it. All right? And I figured I'd come up with the most unreadable chart to start you all up. Some curves you can be safe looking at. Anyway, this is the longest time series I have handy. And it shows industrial production, because we have that all the way back to almost World War I. Do it for 3 reasons. You'd never guess that I'm a business cycle guy. You all think I'm just a finance guy. I stole this chart and a bunch of others from the Federal Reserve Bank of St. Louis, which has the most incredible database. I mean, for a data geek like me, it's like, I can't use that word. It's ecstasy. But everything's put in charts like this. Of course, I know how to manipulate the charts. Industrial production is simply an index of how much the United States manufacturing and industry is producing. It was originally first done way back when. I'll tell you something you probably don't want to know. They keep revising it from time to time by rebasing it. I'm not going to get in the weeds. If anybody's really interested in that sort of question, I'll tell you about it. However, I have some old versions of the same index that look a bit different. Nobody's trying to cheat. Nobody's trying to do something wrong. It's just that they try to update the weights from time to time to reflect where we are now rather than where we are then. And that has some consequences. And it depends on the question you're asking. There's a fabulous book that one of my daughters gave me called How to Lie with Maps. It's in a sense, I think he was inspired in his title by the greatest book ever, as far as I'm concerned, Sam Huff's book, How to Lie with Statistics. Everybody should read that book. And How to Lie with Maps is also pretty good. Very good. Now, so I'm illustrating here. If you see those vertical lines, the kind of gray lines, well, blue, but you got the idea. How about I go back this way? Anyway, each one of those is when there's a recession. All right? And you can see, at least the parts of the graph that are pretty visible, that Industrial production goes down when there's in a recession. Some of them it went down before. Usually it goes down around the same time. It's one of the indicators that the scorekeeper, and the scorekeeper is something called the National Bureau of Economic Research. The National Bureau of Economic Research, the NBER, has been around for a long, long time. They developed an awful lot of our statistics. Eventually, they outsourced them to the federal government. However, it was a private organization. It still exists. And its philosophy, if that's what you want to call it, was developed by Wesley Clare Mitchell. And his idea was, theories are fine, look at the data first. And I'm kind of the same way. Very boring. So the Federal Reserve Bank of St. Louis does lots and lots of graphs like this so you can see how the data behaves around recessions. So the white is expansion, the shaded areas are recessions. And you can see we've had quite a few over the last 100-odd years. So, question is, what's a recession? Obviously, expansion, you're going up, recession coming down, but you know, when do you call it? And let's see. If you saw where I just pointed my finger, I'm sure you really can see every single detail way in the back. That was the recession that the NBER, the umpire, called in 1970. If you look a little bit before there, 1967, 68, thereabouts, there was a wiggle. And as they revised the data, and again, there's nothing wrong with doing it that way. You know, you look at different data for different purposes. You look at different maps for different questions you want to answer. Same with data and same with graphs representing that data. 1970, the NBER said we had a recession. 3 years before, industrial production dropped for 5 straight months. There was a lot of misery. The NBER did not call a recession, and it was very controversial. And this tells you something about human nature, or maybe politics. The economists who were in the school of the monetarists said, no, it was a recession in 67. The Keynesian said, yes, the monetarist says, yes, there was a recession. The Keynesian said no, and they fought about it. That's what academics do, anyway. The key thing to remember here is that the umpire, the National Bureau of Economic Research, they're the one who make the call. That's why those lines are where they are. And they were doing this long before the federal government got into the whole business of economic statistics. And that's going to be something to remember as we look at the last few years, which I think is why you're here. I don't think you care about 1967. Well, you might have had a great car, a good Mustang or something, but now, what's a recession? Oh, I shouldn't do this, but I will. The NBER has a definition. And I noticed the earlier calls are not obvious on their website. I have to do a lot of digging to make sure they haven't changed anything. I guess I'm suspicious by nature. Anyway, they said their traditional definition is a significant decline in economic activity spread across the economy, and that lasts for more than a few months. You usually said a little bit more than that, if I remember right. The committee's view is that each of the 3 criteria, depth, how much the economy dropped, diffusion, how broad broad it was, how many people were suffering in effect, and how many industries were suffering. And the NBR really concentrated, particularly in the early days, on the number of industries. And duration. It used to be that this committee of academics, the business cycle dating committee of the National Bureau of Economic Research, would get around to making a call 2 or 3 years later. After all the data was in, after some revisions were in, they were very cautious. But that doesn't make press releases, does it? And besides which, if the umpire didn't make the call on the guy sliding into home plate until 5 innings later, there'd be a riot in Yankee Stadium or wherever else you're watching the game. The latest recession call, I mean, they made a call very, very, very soon. And I'm sure not everybody agreed with it. You might remember in February 2000, a few things happened in the US. There was lockdowns. Ultimately, we had something like 20 million people lose their jobs or at least stop working. The Bureau of Labor Statistics had to scratch their head a little bit about who do you classify as employed and who not. If someone's at home but not and being paid but not working, are they employed or not employed? Their definitions didn't quite handle that situation. And I have sympathy with it. I knew a lot of those guys, and it's not an easy thing to decide. Well, the NBR said recession started in February of 2000 and was over in April of 2000. The peak was in February, the trough was in April. Now, the first 2 criteria were certainly met. The economy went down hard. If you're in a plane and it went down like that, you'd be saying your Hail Marys, or whatever else you say. And in terms of the diffusion, I mean, how widespread was the pain? Very widespread. Industries all over the place were in trouble. A lot of people were suffering. Well, once you're getting paid and being home, then you weren't suffering. But I mean, there's a lot of economic damage going on, widespread damage. But the third criterion, duration, how long it's going on, well, 3 months? Is that a recession? I'm sure economists will be fighting about this for a while. However, things have moved on and maybe they'll be distracted. One way or the other, the umpire said it was a recession. You've never seen a manager go out and dispute a call, I'm sure. So where are we now, which is why you invited me. But this kind of important background to what's happened, what's happening. First of all, and I know this is the topic I've heard most people talk about earlier, when I'm table hopping. Inflation has struck like we have not experienced since 1965 to 1985. And if you're in Great Britain, it was a lot worse. Still is. And the Federal Reserve decided to jack up interest rates starting in March of 2022 and right up to the latest meeting. They've gone from almost zero at the federal funds rate. And, some of this may sound, it's always a bit of a trade-off between going and explaining everything and losing everybody in the weeds. Sorry. The economists originally looked at a bunch of different things to try to control the economy. Now they concentrate on the federal funds rate, which is simply an interest rate that banks borrow when they're lending from one bank to another bank. That's probably more you want to know than you want to know about the federal funds rate. However, it makes a lot of news. The Federal Reserve, in the process of doing this, has succeeded in inverting the yield curve. The graph up on top shows interest rates. But you know, there's different, you can borrow for different amounts, right? Or if you're lending money to the federal government, you can lend for longer or shorter. You can buy a 3-month treasury bill, lend money to the US government for 3 months. You can borrow a 30-year treasury bond and lend to them for 30 years. And pretty much everywhere in between. All right? That make sense? Well, you know, we economists, we kind of like graphs. Say it with pictures, say it with graphs. Not everybody has the same taste as we have. And what we do is we like to plot interest rates, typically for the Treasury, but I mean, you could do it for others. Take like short-term Treasury bills and bonds, longer-term ones, and plot them so you show the yields against how many years that you're lending to the federal government. So far, so good? Lost anybody? Anybody want to throw anything yet? All right. That picture of the relationship between how much you can get by lending money to the federal government against how long you lend, a picture of that is called the yield curve. So you're showing yields on the vertical axis and how long you lend to the federal government on the horizontal axis. And if I'm being too simple-minded, you can also throw things at me. Well, I pictured here 3 yield curves. I didn't make the graph, I stole it. All the graphs I stole. I might have manipulated them some, but they're stolen. The light gray one up on top, that is the yield curve back in 2019 in August. So we're talking about 4 years ago. And you can see that the short-term rates were higher, the intermediate rates were lower than that, and the longer-term rates were a bit higher. There's kind of a swale in the yield curve. And yield curves take all kinds of shapes. You got hump yield curves, you got supposedly normal yield curves where the short-term rates are lower and the long-term rates are higher. And there's theories behind that. What good would economists be if they didn't have theories? And the next one you see, or you might want to look at, is August 2020, which had been after the sucker punch to the stomach that the economy got with the whole COVID thing. And you can see the short-term rates are quite low, and the longer-term rates are higher. The blue one is current. It's supposed to be current anyway. According to Guru Focus, it's current. I know it can't be quite right because I know what the numbers are. I'll have to picture it for you. You had to use your imagination. Picture a yield curve that goes way high up here and then goes out, kind of flattens out as you get farther out. These yield curves have the vertical axis stretched out. Well, that kind of deceives you in some ways. All graphs, all maps, all statistics can deceive you. which is why it's good to kind of know what you're looking at. These are pretty close to zero in the very short-term rates. Up here, the highest one up there is about 2.1, 2.2%. Let me tell you where the current yield curve is. And I'm afraid my source here has got the current one dead wrong. The current short-term rates are up around 5 and 30%. You go buy a 3-month treasury bill, you're going to be paying 5.3, 5.4%. Or you're going to be getting 5.3, 5.4%, and the federal government's going to be paying 5.3, 5.4%. Sorry. And then that yield curve slopes down and flattens out somewhat as it goes farther and farther out. But the long-term rates are still quite high. They're up around 4.4%. Got myself so immersed in the data, I didn't look to see whether the picture said the story. Sorry, I apologize for that. Now, it has happened any number of times that we've had yield curves where the short-term rates are above the long-term rates. And that's typically called an inverted yield curve. Why? Because people seem to think, or economists seem to think, I guess economists are people, that the normal yield curve, I really defy you to find me a normal yield curve, but the normal yield curve is upward sloping. Short-term rates are below long-term rates. And that's crucial for the success of banking. Why? Because you put money in a bank, you're getting short-term interest. What's the bank doing? They're lending long-term. Banks are lending short, borrowing short from us, and lending long. I put money in a bank, the bank is borrowing money from me. The bank goes and gives somebody a loan, they're making an investment, okay? Well, if they're lending at a higher rate and borrowing at a lower rate, they're making money on the difference. That's the whole principle of banking. Well, right now, short-term rates are higher than long-term rates. Plus, the Federal Reserve decided to do a karate chop to financial markets. They went, and over the last year and a quarter, has raised short-term rates dramatically and ultimately caused all the rest of the yield curve to go up. All right. Who cares, right? I'll tell you some of the people who should care. We had a period that, in my opinion, maybe I'm just too old or too tied up with numbers, where we had short-term interest rates almost zero for almost a decade. Well, I hate to be a banker trying to figure out what to do in that situation. And the Austrians in the crowd will probably figure that's going to cause all sorts of distortions. You don't have to be an Austrian economist to figure it's probably going to do some odd things. I think yellow was one of the victims of that, ultimately. But I can't prove that, so I shouldn't say it. Why is this, what I call the sucker punch to the banking system, so much of a worry? First of all, 75 to 90% of all jobs in the US economy are created by small businesses. Maybe small to medium-sized business. We can argue about definitions. All right? It's not the big corporations that create the jobs. It's the little guys and gals. I mean, that's been true for as long back as you can go. The big guys and gals have lots of options for financing. What about the little ones? It's simple. It's called a bank. if the bank isn't lending, little businesses are going to be in trouble. Obviously, not all little businesses have to borrow, but there are inventories to finance. If you're in that kind of business, a retailer, a manufacturer, you're going to have to finance, just day-to-day operations. If banks aren't lending, you're in trouble. If you're in trouble, employment's in trouble. You see where all this is going? Every time the yield curve is inverted, almost every time, every time the yield curve is inverted in the last 70-some years, there's been a recession. We can argue about 67. I know, I'm still mad about that. Basically, when you invert the yield curve, you're blowing up banks' business model, and you dry up small business loans. And you can see the consequences of that. It's pretty straightforward. Economists usually don't talk about it. I don't know why. So, right now, after a year and a half of, year and a quarter of inverted yield curves, initially, the commentators, economists, newspaper types, and so on, they all go crazy saying, oh, we're going to have a recession. Look at the Fed's raised interest rates. Fed raises interest rates. We have a recession. Now, unfortunately, very few of those economists and even fewer of those media people even remember what it was like in the 60s, 70s, and 80s when we really did have dramatically high interest rates and some pretty dramatic stuff going on in financial markets. So, are we in it? Where were we? Did we go into recession? Informed opinion said yes. Then all of a sudden they said, I don't think so. Now they're talking about maybe we dodged the bullet. What did the data show? Up top, we have commercial and industrial loans. This is banks lending to businesses. Now, that's big businesses and small businesses. All right? But small businesses are going to be much more dependent on this than big businesses. Usually, commercial and industrial loans are considered a lagging indicator. Economy goes up, it peaks, they peak later. And then they hit bottom later. You can't see much of this because of the scale. I'm a terrible graph maker, I'm sorry. I like to look at them rather than make them. But after the 1990-91 recession, we went 3 or 4 years with hardly any economic growth. Employment dropped for another almost 3 years. The NBER, the umpire, said the recession was over. I wrote a memo to my senior management at the time saying, if the recession's over, why do I feel so bad? I think it's the only memo anybody ever read while I was there. If you look at the recession in 2001, oddly enough, commercial and industrial loans peaked right at the beginning of the recession. I was feeling, the dot-com bust, if you remember, was before that. Anyway, again, you can see that commercial industrial loans declined for a couple of years afterwards. Didn't really bottom out until 2004 sometime. 2007-9, the Great Recession, according to my economist friends, which was very severe. And some of you may have heard me talk about how, in part, that was the depth and the power of that recession was directly related to the Beijing Olympics. I'm not going to recount all that. However, the initial part of the recession wasn't that bad. And then all of a sudden, it really got bad. So commercial industrial loans peaked there. If you see that little point, what happens typically in a recession? Well, businesses start getting into trouble. Cash flow disappears, so then they pull on their lines of credit. Commercial industrial loans go up, and then banks have to start pulling it in. And you can see, after a big jump, you get a big drop. And that was a pretty painful recession. When we get to where we are now, this is the same graph, only the right side of it. You can see that commercial industrial loans are increasing after the economy finally semi-recovered. And then we get the COVID recession. I don't know, you can call it whatever you like. And after that, there's a huge spike in commercial industrial loans. I think some of you all probably know what was going on there. We had all these programs, the PPP program, trying to put out loans there, keep businesses afloat as we get through the crisis. Then that eventually went down. Comes beginning at the end of 2001, commercial industrial loans are picking up again. And then they hit a peak and start falling over. I mean, falling down. A little bit, not a lot. Now, there's a couple of ways of interpreting this. And notice, there's probably lots of distortion after all the lockdowns and everything that we're still probably working our way through. But it could be that the ones who think we're in a recession can find some evidence there. Commercial industrial loans are going down. Why? Maybe businesses are going out of business. Maybe activity's less. Don't know. This graph, and I think it's big enough, maybe you can even see it. You can see is showing all employees, total jobs. This is the jobs report. And you can see in the 2007, 2008 recession, you had a big, huge drop, but it kept on going down even after the recession was over. We get to the COVID recession. I'll be good not calling it, well. You can see probably the most dramatic drop in jobs in that graph I showed before of over 100 years. And then a partial jump back. Don't forget, some states lock down a lot more than others. Little aside, I was going through the CDC data, Fauci's bunch, and they have all kinds of data. I was looking at mortality tables and so on, and they also have a list of the top 10 causes of death. I only have data up through, I think it's 2001 and 2. Well, I'm not even sure it's 2002. But anyway, the top 10, you can probably reel off most of them yourselves. What kills people most often? Interestingly enough, in 2001, a new member jumped into the top 10, pushing somebody else out. Cirrhosis of the liver. Don't know why. 2021. Yeah, 2 years ago. Sorry. This shows a different measure of the same thing. And you can pretty much see the same pattern. Are we in a recession? Are we going into recession? You can see the data is pretty mixed. I picked kind of some of the go-to numbers that people look at. This number and the number before showing total jobs. You would expect total jobs to be going down if we're already in a recession. you certainly expect them to be slowing down if we're going into recession, right? My logic correct? Anybody awake? I have a doofy measure. You know, when I had to live or die by some of these numbers, I found that I don't care what people think of what I'm looking at. I need to keep my job. My doofy measure is what is happening to the payroll data revisions. Is the federal government revising them up or revising them down? And I could go into a half-hour disquisition on how the numbers are created and why that happens. But when you're going into a recession, the revisions are mostly downward. When you're coming out, they tend to be upward. I mean, the recession's 2007, 2009. The final numbers that they had for the drop in employment was much larger than the original numbers. And there's nothing Machiavellian about that. It's how you actually make the estimates, which is not an easy job. And I can bore you with that for hours. Anyway, are we in a recession? Or are we going into recession? A, I don't know, but B, I am very, very nervous. I think if we don't go into recession, there's a good reason for us not to go into recession. The Fed might do it to us anyway. And I'm sorry, I've bored you with too many numbers and too many graphs, but I wanted you to see there's actual data behind my thinking. Whether it's good or bad, we'll probably know 5 years from now. Anyway, questions? I gotta stay here still.
Yeah, Biden described his economic program as bottom up, middle out. What's your opinion of that compared to top down economic?
I don't know. Labels don't tell me very much. Data tell me something more. And in terms of policy, and I was fairly good. I try to stay up away from policy today, if you hadn't noticed. He just came out with a big announcement of that they're going to restrict a whole bunch of things to be bought from China. I think if you didn't know who the president was now and the president then, you might have a hard time telling the difference in international trade policy between this administration and the last one. Huge difference in fiscal policy, spending and taxes, and a huge difference in, well, monetary policy. But in terms of trade policy, we're certainly still trying to reduce China's trade with us. And, you know, according to Bloomberg, and I haven't verified this number, I'm not even sure, there's a million different ways of measuring such a thing, so it's a tricky number. They said that China is responsible for 43% of world trade. That's an incredible number, which means if something goes on in China, the rest of us feel it. China's had much more stringent lockdowns than we have. And the economic consequences of this are pretty substantial. I've been trying to make sense out of some of the export and import data, both from China to us, from us to China. And I don't know, if I started throwing those graphs up, you'd start throwing chairs instead of rotten tomatoes. But I think whatever's happened over there has had a profound effect on our economy and the world economy. But I haven't been able to figure it, you know, get from point A to B to C and say, here's where the body lies. Sorry.
The Biden administration seems to be and media likes to report that inflation seems to be going down, but isn't it true that it's just the rate of increase of the inflation rate that has slowed while inflation hasn't really gone down at all?
All right. I could do a real economist thing, you know, on the one hand, on the other hand. First of all, in the U.S., inflation went up dramatically, and again, there's different ways of measuring it. CPI is what we most hear about. That's what you see in the newspaper, the Consumer Price Index. And it's the oldest index we have. It goes back to, I think, 1913. It was even before I was born. The CPI, and by inflation, typically today, newspapers mean the increase, the rate of increase in prices. Prices go up 10%, that's an inflation rate of 10%. And the Federal Reserve, not necessarily that I agree with the Federal Reserve, has a target of a 2% inflation rate. The best period of economic growth that we had in the United States in the last 200 years was in the 1880s, when we had declining average prices and rapid economic growth. I don't know why 2% is such a magic number. And they're more or less meandering around 2% up until about a year and a half ago, and then inflation went up substantially as measured by the Consumer Price Index. Then they take the Consumer Price Index and say, well, let's look at core prices. In other words, take out energy, take out food, because those are A, very volatile, they go up and down a lot, and B, they can be pretty wild. What goes up also must come down. And of course, we've seen to some extent that happen with oil prices. They're not down anywhere near where they were 2 years ago. There's also a different price index, which is much more comprehensive, economists love, and that's called the I hesitate to use this term, the consumer expenditure deflator, or also called the CPE, consumer personal expenditure price index. The Bureau of Economic Analysis goes and estimates how much money people spend on consumption goods each quarter, each year, and so on. Well, that's a nominal amount. That's how much it was in dollars, not how much you got in goods and services, right? So you got to take out price increases, or I suppose add back price decreases, and find out, did what people spent on goods and service go up physically or go down physically? And the index they use for that is this, what I call the consumer price deflator, personal consumption expenditures deflator. Try doing that after you've had a couple of beers. Anyway, that's their preferred measure. And then they look at the core one. In other words, take out energy, take out food. And we all know what happened to energy prices and food prices over the last year and a half. Well, those jumped up and then came down. So what the newspapers call the headline inflation rate, in other words, CPI and the, I wish I could get all the initials right for the consumer expenditures deflator. they've come down a lot simply because energy prices came down from the high level, and food prices came down from a very high level. However, if you look at the core numbers, they're still up around 4.5%, 5% or more. And if you're over in Great Britain, you'd really be slitting your wrists. I mean, their peak inflation rate hit over 10%. And let's face it, Britain imports everything, exports everything. The US generates all the monetary disturbances in the world, and then we export our inflation to everybody else. So we catch a cold and Great Britain has the flu. I'm sorry, I stole a line from somebody, but you know. The Fed's favorite measure is still up around 4.5%. And let's face it, what happens when you jump on, when inflation comes down after it's been high, after headlines been inflation? Guess what? People want to catch up. Wage earners are trying to catch up all they lost, reasonably so. Businesses are trying to catch up with their prices. I could show you a graph. I'll do it orally instead. I think what's really, really, really going on is not the thing that the Fed is fighting. I don't think we're in some kind of crazy overboom economy that has to be suppressed. Rather, if you take total unemployed, people who are looking for jobs, and you take total job openings, and we've only recorded those in the federal, in the Bureau of Labor Statistics data back to 1999. I know that sounds like a lot to most of you, but if you're really trying to figure out what's going on in business cycles, it helps to go back a lot longer than that. But consistently, over that period, up until a couple of years ago, the number of people looking for jobs and the number of jobs that were open, there were more people looking for jobs than were open. And it was a tremendous difference after the recession of 2007, 2009. And there's unthought about, out of sight pain there and damage that's done when that happens. If you got someone that's out of a job for 6 months, well, they go back, take the same job, they probably haven't lost too much. 2 or 3 years without a job, that person has a real tough time not only learning the job they had, which may not exist anymore, but even worse, just the stupid stuff, I shouldn't say stupid, but the tough stuff, the stuff we all do, getting up in the morning. And I'm retired, I appreciate that. Getting up in the morning, it's not something I do as easily as I used to do. I don't have to get there. Being respectful to the boss if need be. Getting engaged enough to ask the right questions. All those things, they don't show up on a resume. But boy, once you lose them, you're very hard to get employed in. Now, there's been a sea change in the last couple of years. The number of job openings has been greater than the number of people looking for jobs who don't have them, yet employed. And what the Fed is doing is shrinking that, rather than realizing, hey, we've got a labor shortage. Maybe we should be using economic policies that encourage increasing productivity so we make the most of the scarce labor we have.
Got a question over here on the side.
That's what I'm going.
First, thank you for your presentation, and secondly, I have a statement I'd like to make that you may use that I have for the people that, particularly the liberals that don't understand money very well. I I offered to sell them this $50 Venezuelan bill. And the last time I checked, it was about a year ago, I think it was worth either 12 or 22 cents. So it makes the point very quickly of what happened. Which leads me to the question, we know that they've been printing money that doesn't represent anything. Do you feel like that will run into hyperinflation and then we'll have a crash? Or do you think that we will just lose our capacity of our dollars and we will crash in that?
I'm not anticipating a hyperinflation. I guess that's good news. Bad news is our
And did you want to buy this from me also?
our fiscal and monetary policy has not been what I would have recommended. Not that anybody has. And that's not just in the current administration. I think we're, well, the US dollar is still the world's currency. We've lost about 10% market share over the last 20 years. We're still 60% of all transactions or more go through dollars. Russia right now is trying to come up with an alternative. Chinese have been trying to come up with an alternative for years. I have a heretical opinion. I don't know if we are helped by having the dollar as a reserve currency of the world, the money of the world, if you will. Yes, it allows us to go after other countries and say, Russia, we're going to cut you off so you can't go into the SWIFT system, makes your life harder, and so on. On the other hand, that means we run a consistent deficit on our international accounts to supply the rest of the world with dollars so that they have money to transact things. I think that means there's less jobs in the U.S., less production in the U.S. But, you know, I'm a minority of one among, I don't know how many millions have gotten this era. And, you know, obviously, nobody has to agree with me.
I had a liberal explain to me that a deficit's not a problem because we owe the money to ourselves.
It is 1 minute after, or 2 minutes after 1. We can continue that conversation on the side. Thanks, everybody. Thank you, Dr. Malcolm Harris. Have a good weekend, everyone.